Welcome to our Financial Basics series. In this video, we are diving into some of the most essential terms you need to know if you want to understand finance and investing. Whether you are looking to grow your savings, invest smartly, or simply manage your money better, knowing these foundational terms can make a huge difference. Understanding the basics of finance is like learning a new language. But once you know the key terms, navigating the world of money becomes much easier. These concepts are building blocks that make complex ideas more manageable and help you become confident. This also helps you make informed decisions about your money. So, let's dive in and unlock the first level of financial literacy together. Assets are resources that hold economic value. Think of them as things that you own, that can either grow your wealth or help generate income. Assets can be as simple as cash in your bank, a house you own, or even the stocks you hold in your portfolio. They are an essential part of building wealth because they increase in value over time or help you earn money. Assets are divided into types like tangible assets, such as real estate or equipment, and intangible assets like stocks, patents, or even goodwill in a business. Learning to acquire and grow your assets is key in building financial stability. By understanding and investing in assets, you are setting the foundation for your financial future. Liabilities are essentially the opposite of assets. They represent what you owe to others. Liabilities can range from loans and credit card debt to mortgages or bills. They are obligations or debts that you are responsible for paying back. Understanding liabilities is crucial because high liabilities can weigh down your finances and limit your ability to grow your wealth. They can be categorized into short-term liabilities, like utility bills or credit card balances due soon, or long-term liabilities, such as mortgages or student loans. Knowing how to manage and reduce liabilities is an important step toward financial freedom. Next is equity. Equity represents the value that you own in an asset after subtracting any liabilities associated with it. If you think of a house, equity is the portion you own outright after deducting what is left on the mortgage. In business, equity refers to ownership of a company's assets after all debts have been paid. Equity is essential in finance because it reflects the true ownership and value of an asset or a business. Building equity can lead to greater financial security, as it is a sign of net worth and financial health. Whether in personal finance or business, growing your equity is often a major financial goal. Capital is the wealth that individuals or businesses use to generate income or invest. It is not just money. The capital can include assets like equipment, buildings, or even intellectual property as long as it contributes to production or income generation. Capital is divided into various types, such as working capital, which covers day-to-day expenses, and venture capital, which supports startups. In personal finance, capital might be the funds you invest in a business or stock portfolio. Accumulating and wisely managing your capital is a major key to growing wealth and reaching financial goals. A balance sheet is a financial snapshot that shows assets, liabilities, and equity of a company at a specific point in time. It is one of the main financial statements that businesses use to track their financial health. The balance sheet follows the formula: assets equals to liabilities plus equity. This formula ensures that financial position balances out for any business. This shows how assets are funded. Is it funded by either debt or by owner investment? For investors, understanding a balance sheet is essential for assessing financial health and stability of a company. This makes it a key tool in financial analysis. An income statement, also known as a profit and loss statement. It provides a summary of revenues, costs, and expenses, for any company over a period of time. It shows whether a company is making a profit or incurring a loss. The income statement follows a simple formula. Revenue minus expenses equals profit or loss. This document is crucial for understanding profitability and financial performance over time. For investors, an income statement helps identify trends in revenue growth and cost management, making it an essential part of financial analysis and decision making. Cash flow is the net amount of money being transferred into and out of a business. It is different from profit because it focuses solely on the movement of cash, which can be crucial for short-term financial health. Positive cash flow indicates that a business or individual has more incoming cash than outgoing, which is good for covering expenses or investing in growth. For businesses, understanding cash flow is essential to avoid liquidity problems and ensure they can meet their obligations. Investors look closely at cash flow statements. This helps them to assess financial health and operational efficiency of the company. Compound interest is interest calculated not only on the initial principal but also on the accumulated interest of previous periods. Imagine earning interest on both your initial deposit and on the interest earned in previous years. This interest on interest effect is what makes compound interest so powerful. It is often called the eighth wonder of the world because over time, it can dramatically increase your wealth. For investors, understanding and leveraging compound interest is fundamental for long-term growth, whether in a savings account, investments, or retirement funds. Diversification is the practice of spreading investments across different assets to reduce risk. Instead of putting all your money in one place, diversification means owning a variety of assets, such as stocks, bonds, or real estate, which react differently to different market conditions. This strategy helps to protect your portfolio from significant losses. If one asset underperforms, other asset can give performance. Diversification is a key principle for managing risk in investing and is often recommended as a foundational strategy for building a stable and resilient investment portfolio.